Alrighty, folks, we are going to bring something that Anna Kelly and I have done the last couple of weeks to Taylor in Life Goal Investments. We are going to steel man 2 ideas and let you know what our thoughts are. The first one, unfortunately, is the gloom and doom. We're going to talk about the S&P 500 being destined to go sub 4,000. In video number 2, we will talk about new highs this year. Alrighty, Taylor. You put out a lot of stuff on Instagram. You put out some pretty scary stuff. Sub 4,000 S&P 500 is actually easier to think about than most people think. How do we get there? What is happening, and where are we going with this thing?
Yeah, so there are a few different ways you get there. I think there are a few different components of, without a black swan driving us down to that kind of number. The first one that's on everyone's mind is tariffs. If tariffs sustain and persist, it would be shocking to not see it go there, to be candid with you. The other piece of this is the fact that our government, although it's gone in the background right now, has vehemently said now we are going to run a 3% budget deficit versus a 7% budget deficit. So you have the government effectively putting its foot on the brake on their spending component of things, i.e. Doge, i.e. cuts, etc. The next area is just interest rates. So depending on where interest rates go, and I know you know this all too well in your real estate business, but if we continue to see price pressure because of tariffs, you could have the long end of the curve back up, and thus the cost of financing on everything balloons. And then the last one I'll put is, on top of all this, with all of the uncertainty that we have in the market right now, we're currently at a forward price to earnings ratio of 20. 20 puts us 1 standard deviation above the average.
Right.
So that's the recipe. That's the cocktail as I see it. I'm sure you can add more to that. What do you got on your end?
Well, I think the big one that you missed, but it's what you're doing on Instagram. So again, Life Goal Investments, follow them on IG. It's the earnings, right? We're starting to see more and more companies disappoint, right? Earnings to this point, quote unquote, were okay, but that's because a lion's share were financials, right? We saw Delta, we saw United. We just saw, Chipotle last week. We got Domino's Pizza this morning. We are seeing more and more demand destruction. We got 72% less flights from Canada to the U.S. We've got less stays at Airbnbs. It's just a recipe. I don't know why Wall Street analysts haven't woken up and taken EPS down.
It's shocking.
What the hell?
I'll add a little context. I didn't mean to cut you off, but just add some numbers around it. The current yearly estimate for this year is that earnings will have grown 9.7% for S&P 500 companies. I don't know. I have no idea how you get there. I just don't. I have no idea how you get there. And you are, to your point though, you are starting now in the last week or two to start to see earnings estimates come in being down.
Yeah, but it's like a drip. I mean, a lot of people that I'm reading to or I listen to have basically said the following in different terms. I'm writing off 2025 growth. I've moved all of my 25 growth to 26 and 26 to 27. That's not a recipe for 9% growth in the S&P 500.
Totally.
So, when I sit there and you tell me that, the multiple's 20, I actually say bullshit. It's not 20. It's more like 22 or
24,
23.
right?
24. And now we're like 3.
To be clear on just how the math works, this is forward price to earnings multiples. So what they're doing is they're assuming that you have a 10% earnings growth. And that's what gets you to a 20-time multiple. So if you don't get that 10% earnings growth, that multiple just ratchets higher. And so you're 100% correct. And that's something that I've spoken about a fair amount on our channel.
Oh yeah. I got it from you. I'm stealing your thoughts.
No, but you're 100% correct. And it's just, talk to anyone right now, anyone, especially someone who runs a business, and say, can you in your right mind forecast a 10% growth for your own business right now?
No.
For the year of 2025. And people are always more optimistic on their own situation than the broader situation. Can you forecast a 10% growth and back me into that number? How do you get there?
No. I mean, other than the big tech companies, the 1% of the market maybe, but it's just not there. And I'm spending more and more time talking to small businesses, and every one of them is telling me, they're nervous about the future. If maybe you're a service company, you're not as impacted, but there's a lot of small businesses that rely on international trade, and they're like, we stocked up on inventory a little bit, but we don't know when this stuff's showing up. We could be out of business. So we really are on a very scary path. And this, if tariffs don't, I won't even say tariffs. If the uncertainty doesn't get incrementally better week after week after week, we're going to have a huge problem.
Yeah.
And, a flat 25 is going to be best case, right? What happens if earnings go down 5%?
Right.
Then what happens?
And there was an article in CNBC over the weekend just talking about the farmers. The farmers are getting decimated.
Yes, I saw that.
Just getting wrecked. They're like, listen, and this shouldn't come as a surprise. We saw it in 2018 as well, when China just, said, hey, okay, we'll pull back from our soybean purchases, from our grain purchases, et cetera. Like, there's no sticker on something that lands in China that says made in the USA. It's better because it's made in the USA. So if it's cost prohibitive for them to do business with our farmers, guess what? They're going to go to Brazil. And that's exactly what they're doing right now.
Yeah. And this is what I keep telling people. I think the Fed and Powell are nervous about a ghost of inflation. I think the real problem is deflation, right? Just think about the farmers, right? If they can't sell their product, right? The problem with farming is, right, they've already put out all the money, the seed, the water, the fertilizer, right? That's all adding up. Now they've harvested, again, money going out the door. Their buyer's gone. They're going to try to sell to somebody else at a discount. That's going to potentially be deflationary. Or they're going to just see the stuff spoil, right? This stuff has such a short shelf life.
Correct.
And it's going to be horrendous, I think.
Yeah, and that's the easiest one to put your finger on. One, it's the one that everyone roots for the most, right? Who doesn't like a farmer, right? This is salt of the earth people. We want to support them. We need, crops being grown in the United States because, that's what we all feel good about is having our own food, homegrown, et cetera. That's an easy one to point the finger at, but that's not it at all. I mean, autos, you've seen auto prices whipsaw around because made in America is not made in America at all. It might have a GM Ford.
It might be assembled.
Cadillac. Yeah. Right. But it's not made in America. 50% of the parts are coming from outside and they're getting shellacked.
Yeah. The other thing that I think is not being talked about, and I'd love your insight on, is I'm really concerned about the diversification out of U.S. assets, right? We heard from the ECB last week that they were over-indexed to the U.S. assets, and now they're going to be neutral, which means they're going to take some percentage, 5, 10, 15% that used to go to U.S. assets and move it elsewhere. I wonder how much of that money ended up in the stock market, ended up in index funds, ended up in individual stocks. If we have less people buying them, that's a problem. And, oh, by the way, to your point on rates, that is what the real boogeyman is. If we have more and more people selling U.S. treasuries, rates will go up. And, my fear is we hit 5%. Shoot, we go above 5%. We get some really nasty surprises.
And there is some fear in the market that we have this massive, massive ownership of overseas foreign governments in U.S. Treasury. I'll provide a little context here. China is the one that everyone talks about. China, as of the recent data, has roughly 2% of our Treasury ownership in China. So granted, that is still a seismic number. But I do think there was a little bit of a coordinated puke of Treasury assets back onto the market when tariffs first hit. And that was their slapping the wrist of the Trump administration saying, guys, we aren't going to take this. We're going to cause your debt financing as a country to continue to balloon here. And it's something where, that is, warfare financially that's taking place there. And I think we saw it firsthand by the 10-year snapping up 38 basis points, 0.38% in 2 days like that. That's almost the fastest pace we've ever seen.
Yeah. At the end of the day, when I think about S&P going sub 4,000, it's really easy to get there in my head, right? We're suffering through the most uncertain market. I have never, and I've been studying the economy for 30 years. I have never seen a time where consumers, small business, and investors are sitting on their wallet at the same time. I just saw a report from CNBC this morning, Diana Olick, talking about real estate. And basically, buyers are on the sidelines. They're just like, I give up. I'm too nervous. I don't. And this is what I told people was coming, demand destruction. And the problem with consumers is once it grabs hold, it tends to stick around for a while.
Yeah. It's a self-fulfilling prophecy of, okay, the thing just keeps, bleeding into itself and everyone gets more and more nervous and the demand just
And then layoffs start, right?
Yep.
Demand, then layoffs, and then it's just like,
Yep. Yeah. We just had the slowest housing sale pace since 2009.
Yeah.
Like,
wild.
I mean, yeah. It's almost 20 years, right? So,
yeah.
So those are all the outstanding problems. And I'll just kind of, pick at one more scab here a little bit more fully. The movement from 7% budget deficit to 3% is a massive one. Like that is absolutely
it's a lot
seismic.
of spending. Yeah.
We had coming out of COVID, we spent more than everybody. For context, we spent 25%, the government, of our GDP to keep our economy afloat. Government spending was 25% of our annual GDP in a 1-year time frame. The next closest was at 18 in Australia, and it was 16 in Europe. Like we spent like drunken sailors, and now we're paying some of the retribution for that. And how far does it go? That's what's yet to be determined.
Yeah. At the end of the day, I think Q2 is going to be very interesting. We also get a lot of earnings this week, right? This is I think
this week's huge.
40% of the S&P 500. I'm looking at companies. Actually, I wrote them down, so I'll pull it up. I'm looking at Domino's Pizza this morning was a big miss. We got Coke, UPS, GM, Royal Caribbean. I mean, all of these companies could come out with just some nasty, earnings down. We got Starbucks as well. Caterpillar, right? How many projects have been canceled? Caterpillar, Qualcomm,
Microsoft,
Meta, Hershey's, Estee Lauder, Apple, Airbnb could be a disaster. Man, there's Amazon. Oh, it's a massive.
What will be more fun and important to listen to is not, hey, this is what happened in Q1. It doesn't matter. Q1 doesn't matter whatsoever. It's what do you foresee coming? And I think the big trade that is still massively in question, is the AI trade. Are these hyperscalers like Microsoft continuing to spend, Meta continuing to spend and buy up every NVIDIA chip on the planet? NVIDIA might be the most important stock to watch this week, even though it doesn't report for another month or so, because you're going to get an idea from these big players. Okay, is this actually a race that we need to run at our fastest pace to keep up? Or does one blink and then they all blink?
Yeah, for me, it's the consumer. And again, I'm going to actually be interested to see, how many people pull guidance, like no guidance at all.
Right. How are we going to tell you what's going on if we don't know what the hell is going on? That's what they're going to say.
Yeah, I'm just going to wild guess it. More than 50% of companies will just simply pull guidance for Q2, right? Some of them will pull guidance for 2025. I think 50% pull for Q2. I'm
interested on the consumer for Meta. Meta is the one that I'm interested to hear on the consumer front, because what that is, that's direct B2C. Businesses spending money that get consumed by consumers at the end of the day. So are they still feeling their dollars are effectively spent convincing the end consumer to buy their product with their spend on these social media platforms? That's an important one.
What one am I most interested in? As somebody who likes to travel, I'm going to take Royal Caribbean as the one that's kind of off the wall. Also, UPS might be interesting.
UPS, yeah. Are we collecting packages at the same rate we were? It'd be very interesting to see.
Yeah, so I think this might be the week that analysts wake up and realize they got to take their earnings down, which again will take the multiple from 20 to whatever, 22, 24. I think this week's going to be important. S&P 4,000, sub 4,000 is not impossible.
No,
it's not zero.
Well, I just said my video today on social media, and I gave some reasoning behind why that is. I said, listen, if you were not sleeping well at night because you had too much public stock exposure, like you just got to get out of jail free card. We're 14% off the bottom.
Yeah, no, I think that's exactly right.
It's a good time to, if you're not allocated correctly, like spend some of that down. Even if you're taking a loss here or there, and reallocate it. I'm not saying blow out of stocks. That's never my my position. But having alternatives in the portfolio, having bonds in the portfolio can provide some ballast, so you can sleep at night.
There you go, folks. Yeah, at the end of the day, folks, if you're not checking out Life Goal Investors on Instagram, investment on Instagram. Need some more coffee.
You got it. You're all good.
Check him out. Go check him out on Instagram. Thanks, buddy.
Thanks so much, Michael.